First of all, I think the difficulty there is finding what is still available in a good market, because generally someone is already there. But we're finding markets that are growing, that have not been supplied appropriately in the past few years. That's helped, and we have 3 projects that we're working on right now for new construction, and we'll be working on a few more. We'll try to do 3 to 4 a year, and we see no problem doing that with the rebounding economy. So supply is still low, and in the specialized areas there's significant demand still for specialized products.
The discipline around a new construction project is do not start it until you've drawn it. A lot of people want to start with 30% drawings because they're in a hurry. Always a mistake. Have your drawings nearly complete, construction drawings. You need your CDs completely done. And then don't vary from your original idea, even though it seems like it's great. Now, if you've made a mistake, obviously you'll correct that. But in cost overruns, frequently they're because people set a plan in place and then change their mind. Rarely does the change in mind drive additional revenue or additional profitability. It's usually around some personal like, or somebody thinks it's a better idea. The fewer people that have the ability to make changes to the plan, the better, and the fewer changes to the plan, the more likely are that you're going to deliver that project on cost, on time.
Certainly, you better take a very close look at what the market will give you in terms of once that hotel is open, what kind of top line do you really forecast in a candid and honest way relative to costs. Costs, as far as construction goes, have become a little daunting. Contractors, for the first time in several years, are able to have real pricing power. We've seen double-digit increases in hard cost in the last few months, and they're even creeping to in the teens in some facets of construction, like drywall. So you've got to be careful. But the good news is when RevPARs are increasing at 6 to 8% per year now for a few years running, there's a lot of velocity in terms of what developers are doing and what risks they're ready to take.
You know, financing, looking at the land cost, development cost, and making sure that it works out well in terms of what the ADRs are out there. And you also have to look at the fact that from a long-term perspective, barriers to entry. In the past, you know, some of the reasons that the cycle has gone down is because a lot of new competition comes in, and all of a sudden you're not able to get the rates that you did in the past. So looking at deals even if it's more than what it should be, if the barriers to entry are high, makes much better sense.
First and foremost would be understanding the realities of the market and how it's likely to change, i.e. the market where the project is located. One of the more challenging things we're seeing now, and we're watching this very closely, is the cost of development. In the vast majority of markets, land prices, building materials, construction labor are growing at a very, very significant rate. So on the one hand, we have hotel market fundamentals continuing to improve at a very, very attractive rate. There's really, in a sense, a competition going on in terms of what's growing faster, the hotel profits or the cost of new development. So we're watching that closely. So again, we're much better off than we were a year or two ago, but we don't think anyway that we're quite back to the point that we saw back, certainly from the previous peak in the development cycle back in the 2008, 2007 period.
It's always entry cost, no matter what. Number one, you need to go in, make sure you do your due diligence on the market, make sure that the market's performing, make sure the demand generators are strong and growing, and then it comes to entry costs. Obviously, pricing is going up for construction. First of all, is land. It's not just hotel developers looking for land, it's apartment developers, and haven't seen the office development yet, but so there is competition for land, so land pricing has gone up. And then it's making sure that you have a really good contractor, making sure that you're building this thing for the right price to match that market. Because if your entry cost is too high, the project's never going to pencil.
In terms of evaluating new construction, for us, we evaluate hotel development relative to other opportunities in asset classes such as residential, office, and retail?
You know, when looking at new construction projects, I think our clients are very sensitive to the overall capital stack, making sure that they have the correct balance between equity and debt, and also looking at the efficacy of a project to make sure that the demand drivers are in place in the specific markets that they're looking to develop.
Well, we're really lucky these days. The capital markets are wide open for hotels. Obviously, the projects have to hit a high mark in terms of feasibility, low risk, the right basis, and those kinds of things. But with capital sources like EB5 and aggressive local and regional construction lenders, there is capital there if a project is feasible. So we feel like we can be very selective, and the capital will be available for us to move forward.